interesting.
If you're a business owner, you cannot do your tax planning at the same time you're filing your tax return. It is too late. All your tax planning really should be done 4 times a year.
Yeah.
So you should be going in every single quarter for a tax meeting.
Welcome to a Wiser Retirement Podcast. Entrepreneurs, are you curious about how to manage an irregular income? I'm Michaela Dowdy, and today I'm joined by Casey Smith. Each week, we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Welcome back to the podcast, Casey. It's been a few weeks.
That was pretty good, Michaela. I feel like it's hard to sit on the other side of the table and listen to your own intro, but that's pretty good. That's pretty good.
A little, not as good as the expert here. I feel like you've got it down to a science. I still had to think through that.
Episode 200 and what does that say? 91.
Yes, almost 300. 291
times we've had a chance to say an intro.
There you go.
Not bad. Not bad. Yeah. So we haven't recorded a podcast in a few weeks. I'm not sure. I'm pretty sure I did the last episode, but I've been traveling. We've got, I got kids that have ambitions. So not even traveling for my own self. I haven't gone any place super cool, unfortunately, but let's see. We started off with 2 golf tournaments back to back. My son, who's 19, he's a freshman, or I guess now a sophomore in college. We did, let's see, what was the first one? The Magnolia at Druid Hills Country Club is an invitational. And then he played in the Georgia Georgia Amateur.
Yes, he did. Mm-hmm.
That was fun. I was his caddy both times. And no one should ever question my dedication to being a caddy, because I was having some health issues. I ended up trying to get rid of 3 kidney stones in the process of carrying a golf bag in the excruciating heat for 4 days. It was a 4-day tournament. I did not go to the practice round. I skipped that one, but we went 4 days. Ended up getting 6th place.
Yes,
I was proud of him for that. It's hard, man. It is hard to close out a golf tournament. Like those last 3 holes on the final day, it's tough mentally. Yeah. It's tough. You probably could have been inside 5th or 4th, but we fell to 6th at the end. And then we went to Destin, Florida for a week for my son. He had like a World Series, Perfect Game World Series golf baseball tournament.
Yes.
But I would say World Series is a very loose term. I found that everything in the summer is called the World Series.
Yes, it is.
So they won their championship. That was fun to watch. We haven't had that great of a season. It's kind of a 50-50 season. Mm-hmm. So it was nice to go out on a win. And then last week I was with my daughter up in Maryland for the Young Rider Championship, which is horses. And what happens is you get a team is selected from each region. I believe there are 7 regions. It could be 8 regions in the country, and they all end up in Maryland. So they had people driving like 3 or 4 days with their horses to get to Maryland, which logistically, you think about that, like there's a whole Airbnb site just for traveling with horses.
That's incredible.
So you stop in these people's farms and they can graze and like they have stalls and stuff.
That's awesome.
Hopefully they have housing on site. Anyway, we didn't have to do that. We drove 12 hours. It took about 12 hours to get to Maryland. It's right outside of DC, and she did well. She got 3rd place overall, which is a actual silver medal.
Oh wow, amazing!
And then the team got 1st, so the Southern region won the championship. And then we drove home, rolled in at 2:00 in the morning, and here I am doing a podcast. And then the same week, my son was another golf tournament down in Columbus, Georgia. Man, it was his to win, and again, got to close it out those last 3 holes. So he's working on his mental game over those last 3 holes, I guess. But it's been fun. So, and I know we have so many clients that know my children since they were born. Some of them. My 17-year-old, some of them not at the hospital, but like 4 or 5 days after she got home. I mean, they were holding her at the house. so a lot of people had vested interest in the Smith children and what's going on. And they always forget about Owen, because Owen came a long way after. So everyone's like, what? You have a third child? I was the same way. Ethan went to college and I walked in. I was like, all right, we got one out. We got one left. It's like, wait a minute. No, there's one more.
He's a little excitement.
he's the happy, quiet one. So he's a lot of fun. His things are more, he's into his sport, which is baseball, but he's really more into like race cars, and he likes watching F1 and doing all that stuff. So,
I mean, can't go wrong with racing.
No. And thanks to everyone here, because I am able to be the best dad because I have a great team here that honestly, sometimes I'm like, do they even need me? I don't even know why. I don't even know why. You know, what is my purpose exactly? It's we'll talk about that today, but entrepreneurship, but it's a weird feeling knowing that you could just like keel over and die, and they might be sad for a day, but
oh my goodness,
but Weiser's going to run just fine without me.
No, we'd be very sad. We would be very, very sad. There would be a lot of things that no one would know how to do.
I've always said you hire people better than you. You always look for people that are better at things than you are, and I feel like that's what we've done. So we have a team of almost 18 now.
Is it that many?
Yeah, because we have some people who work remote.
Yes, that's
true. In the office every day. So we have 18 experts, and honestly, they all can problem solve. So we're in a great position as a firm right now.
Yes, which I feel like, you speaking to that, that's really kind of the goal of an entrepreneur. So I feel like they want to have, that ability to have, that time where, hey, I want to be able to you don't make your own schedule by any means, but,
right.
Being able to say, hey, my son has a golf tournament and I want to be there to be his caddy and like be present in those memories with him. And like, I think that's a huge driving force of entrepreneurship.
The flip side of that is you're also then working
every hour of the day.
some other time. I mean, I don't want to paint roses here. I mean, my kids all the time go, why is he always on his phone? Why is he always on his computer? Well, it's because you guys get to do nice things and I have flexibility, but yeah, we took a risk a long time ago, and it's starting to pay off.
No, definitely. And I feel like it just takes a while for that time to kind of like pay off and find that overall once you have the right team. And I feel like that's what you're kind of speaking to, is once you have that huge team.
That's something you have to learn though, because I work with so many business owners, and honestly, some are really, really good at their jobs, but they can't break away because they haven't hired the right team around them, or they don't trust themselves or understand how to scale. How to scale a business is really difficult. And you have to let go of so many things and create processes for so many things that most people have a hard time with that. I remember a long time ago, I was a consultant for people who own a couple of laundromats, and it was up in North Georgia. And I came to the conclusion after working them for like 6 months that they just needed to sell everything and they needed to go work in a laundromat because they were really good workers. Yeah. They were horrible business owners.
Yes. Well, it's a different skill set, I think 100%, and it's something that you really have to have a fine-tuned skill for. Granted, I feel like though we live in a society though, especially now, where it's like, be your own boss, chase after entrepreneurship. Right. And it's like, not and that's not to say you couldn't learn those skills, but I think it is something, it's a lot more difficult than just the roses that you see where people are getting to, be a part of different events in their families' lives and that kind of thing. They can make it seem so exciting and great. There is a lot of, also sacrifice that comes into that as well.
There's lots of sacrifice. There's a book, Michael Gerber's E-Myth Revisited. I would recommend every business owner read that at the same time every single year. Because every time you read it, you're going to extract something different out of it. But he talks about there's a entrepreneur inside us, there's a manager, and there's a technician. And what happens is we're a technician, we're working in a firm, and then we get the entrepreneurial seizure that I can do this on my own, and I can bill it, $475 an hour, and I get to keep all that as opposed to my boss just getting most of it, and I get a little bit, and I can do this better. CPAs come to mind when you think about this. But then what happens is, after you've had that seizure, you become a really good technician. You might be a really good CPA, or you might be a really good, painter, or whatever it is that you're doing. And what will happen is people will flock to you, and then you have all this business, but then your quality of work goes down because you've got so much business and people are getting frustrated with you. And then next thing you know, you forgot how to sell. You never learned how to be a manager.
Yes.
And he walks you through that process in that book. It's a great book. I have not read read it. I didn't read it last year. I need to go back and read it again. I usually just listen to it when I'm on a couple of boards up at Berry College, and so it's an hour drive. So typically during board season, I can get most of the book in on the drives up and down. So that's a good reminder for myself. But yeah, it can be difficult if you don't have time to plan and think. I think I did my best thinking and my best strategizing when I was a dual career person, when I was flying airplanes in the Delta system, and then when I also was building the firm, because flying an airplane at times is like watching paint dry. You're just sitting there, and so you're alert. You're looking at the instruments, but autopilot's on, and you're just thinking about things. And that was my best strategy.
Yeah.
So people pay $30,000-$40,000 for these coaches, and sometimes I'm like, you don't need a coach. You just need to go
Have
take a break. You need to turn your phone off and be incognito for a few hours somewhere far away, and you can come up with a lot of good ideas.
No, definitely. Well, I wonder if too it was partially, also having the security of knowing that you did have another income stream too while you were in the formation phase.
Yeah.
That it does make you more apt to take more risks and that kind of thing with growing your business.
Oh no,
considering you had another income there.
That's one of the main reasons why we're fiduciary and fee only, because I didn't have to go sell anything to put food on the table when I first started the company.
Yeah.
Otherwise, you'd be really tempted to sell that whole life insurance or sell that annuity to somebody who doesn't need it.
Yeah, no, 100%.
Because you got to make bank this month.
Yes.
And I never had that pressure. I had the pressure of exhaustion.
Definitely.
But I didn't have the pressure of the dollars, because I had another career that I could that was supporting me. And obviously I kept doing it. I think as an airline captain, my last few years, I don't think I made more than $40,000, and it's because I dropped all my trips so I could be here more and kind of work the system.
Mm-hmm. No, which I think that kind of leads into our first point, or really just kind of even the title of this podcast, of managing that irregular income and figuring out, whether it is, having that second job that kind of provides while you're still building your company and your business, but really it's, figuring out how do we manage our finances in this in between, or even in the fluctuation of income where you don't know exactly what it'll fully look like month to month. And so, talking through that first, as we had kind of even spoke before, starting this podcast today, of creating that personalized financial plan and building that, baseline budget. So, what are Casey, some high points that you would say as an entrepreneur yourself that have really helped you be able to manage both of those?
Well, giving advice to entrepreneurs is very different than working with a normal person who goes to work, even a CEO of a big company. It's different. So entrepreneurs, typically their brains are wired a little bit differently in how they think about things. For me personally, I am an entrepreneur. My brain is wired slightly differently than others. I don't quite fit into the financial advisor world, who are kind of stuffy and very super conservative about things. I also didn't quite fit into the aviation world, although I loved it, but I wasn't the same as the mass. Yeah. And so finally one day I met some people, and someone had told me, he says, well, you love aviation, but you're not a pilot in personality. But you're also not a financial planner in personality. But you are as an entrepreneur, and you have the ability to be a lot of different things. So anyway, you have to embrace that. So I say all that to say, you go work at a job, you put money into a 401k plan. Almost all of our podcasts are about this, about saving and how much you should be saving and keeping debt low. Entrepreneurs may not think that way, because there has to be a risk taken at some point. So for me, I found a problem. The problem was that the financial service industry has over 90% of people who are trying to sell you a product, not giving you real financial advice. They'll say, consult your tax person, consult your attorney, consult your, everything but giving you advice on all the stuff you need. If you're a wealthy person, tax and estate planning are the two most important things.
Exactly.
Right. And so what was missing was this quarterback, sitting at the table going, okay, this is our strategy. This is the CPA. This is the attorney. Let's coordinate all this into a strategic plan. And I'll kind of be the quarterback of the team. Obviously still working for the owner, right? In this analogy. So when we saw that we wanted to solve a problem, a lot of times there's not the runway is very short to launch into this new career as a business owner. And so when the runway gets short, you have to put everything you have into that concept. So you may not be saving into a 401k. You might have bare bones healthcare. I mean, some people have no healthcare. They're just trying to get this thing off the ground, right? So they're not everyone goes on Shark Tank and wins with their concept. And every time you get to Shark Tank, you see there's been a lot of pain typically before that point.
Definitely,
right?
100%.
So you don't fit into the box. You probably don't even have regular income. Honestly, the income is probably somewhat variable. So what I would tell people who are starting out in a business is that there's risk here. There's risk that you could fail and you cannot make it, but you got to give yourself a time limit and say, I'm going to try this for 5 years, or it's 3 years, it might be 2 years. I'm going to try this. If it doesn't work out, I'm going to shut it all down and say, this was a great learning experience. And I'm going to move on to something else that can support me and my family. Right.
Definitely.
So in that case, you're not saving. And so for those people that I work with, I don't even build a full retirement plan for them. Why would I sit down in front of an entrepreneur who has these great ideas, who's trying to solve a problem, who thinks they can go to market with it, and they think they can build a business? Why would I tell them you're not going to be able to retire? Like, they don't need any negativity in their life right now. So typically what I tell them is, it sounds like you have a great plan. Here's a book, E-Myth Revisited. Your marketing book, Donald Miller, marketing. Oh, what is it?
Not
Building a Story Brand. Thank you. Building a Story Brand 2.0. There's a 1.0. 2.0, I think, takes into more account with how AI can help you in building your marketing strategy.
Oh, cool.
So Building a Story Brand 2.0. And then if you can get your marketing going, if you can get your concept out, then maybe you can start growing a firm. I also have a business consultant that I'll refer people to and say, hey, go see, or go talk to Marty at Paradise. He's in Charleston, South Carolina. He'll do video chat with you, and he can help you. He's an expert in all the business coaching. There's 3 main systems, and he's an expert in all 3. So he can really come to where you are and help you with that. Then the next phase is you have a business that's growing. You have a couple of people. This is where, okay, your business is maturing. And so for these people, money could still be somewhat in flux, but now you have to start thinking about, okay, I have a business. I want to make sure that I'm building value in my business. This business could be sold someday, but you could also start a 401k plan, or a simple, or a SEP, or something that you can start putting money away. And so if we can even just get a few $1,000s away, not, I'm gonna say each month, but even a quarter, but maybe a few $100s every month, you're starting to build something that's separate from your business.
Definitely.
And then once your business has matured more and you have a good business, then you should be maxing out a 401k plan. But at that point, honestly, that's not going to be enough for you. So now you have to start saying, okay, what's my exit strategy someday in my business? And what is, I'm maxing out, but I'm maxing out for tax benefits. But that money probably wouldn't be enough to sustain me. My value is still in my company.
Yes.
So long-winded answer, but the point is that there are different phases, and in those different phases, you need to be hyper-focused on really one thing, and that's getting the business off the ground, getting the business matured, and then getting the business where it's you have an exit strategy. And most people just think, I'm going to sell my business someday. They've never talked to a business broker. They don't have any,
So true.
they don't have any evaluation metrics whatsoever. Their number in their head could be totally different than what reality is. They have no benchmarking on for their industry and what things sell for. You have to start thinking about that 3 to 5 years prior to doing it.
Oh yeah, minimum for sure.
So the point is that you don't fit into the box. There are other things that are consistent, like life insurance. If something happens to you, what's going to happen to your family? And if you're doing this when you're young, it's a no-brainer. You're going to pick up $3 to $5 million of like term life insurance, something cheap, knowing that your family's taken care of. The business will probably go under if you're not there, most likely. It'd be hard to sell because it's all about you. So there's estate planning. Those are all basic things that we still get done, but the retirement projections are very, very different.
Yes. I think, you've kind of like just touched on how all the differences of entrepreneurship and, making sure that while you're building that business, you want to make sure that you're still feeling like motivated. I think if we had a client that walked in and they're like in the throes of building their business and we were to hit them with, yeah, you can't retire. Like your plan doesn't work. How defeating would that be? Like you don't need someone that's looking at you like that. Now, of course, if it's like, okay, we've been at this for 5 years, 10 years, whatever. And it's like, this is not showing success. And maybe we do need to have a harder conversation. But at the point where it's, you're building a business and it's still definitely just in those throes of being built.
And to be honest, I don't meet with a whole lot of people that are in that phase. You know why? Because they're heads down trying to figure this stuff out, right?
Exactly.
Most people we get is more mature phased business owners who, okay, I'm a business owner. This is what's happening in my business. It might be second or third generation sometimes, but yeah, if I could reach out to the people who are in the build up phase, there's a lot of things that can make a big difference, and it has nothing to do with financial planning. It's really more on the business coaching side, which we don't actually do, but I'm just teaching from, sharing information from my own experiences.
Yes. You're like the people that, like go to therapy and then they're like, this is what my therapist said, this is like my little key token. Like there was a thing for a while, I feel like online, that's what they were like. This is my like phrase. My therapist told me this today. Right. And it was just kind of funny because it's like, oh, that's a great token. But also, you should also get your own at the same point. Exactly. That's, more based on who you are. But, you're talking about all these different phases. So I feel like a common question that we get a lot with our business owners is, well, what about an emergency fund? When does that need to be built? Because I know you're talking about this. Yeah. Well, you have to put everything into your business. Well, where is the safety net? And when does that safety net come into play?
Yeah, you still have to have you have to separate personal savings from business savings. I did some consulting with a charter company, airplane charter company, many years ago now. And one of the engines, they fly King Airs. And so they had a hot section. I mean, the engine had to get replaced and it's over $1 million for a King Air engine. And I said, okay, that sucks. How are you going to pay for that? How much do you have in reserves? He's like, I don't have much in reserves. I'm just going to get a line of credit on my house. And I was like, wow. Yeah. So there has to be business planning done, kind of like personal financial planning, but inside the business that either have business line of credits, preferably not tied to your house, or you're building reserves. So maybe you're not charging enough for your services because you don't have enough reserve built up. And the reserve can be built over time. So you might have a low reserve. I like to have at least 1 quarter's worth of payroll in our firm in reserve. There's not many other things that would surprise us outside of a huge market dip, and those are usually temporary. So I've thought about the worst case scenarios, and to me, I'm comfortable with that. Another person's business might be different, especially if you don't have recurring revenue. You're selling like a retail store. Well, what happens if all of a sudden a COVID-like thing happens, right? Or the shop, floods or something crazy happens and you can't sell for an extended period of time. How do you keep the business going? And then you personally would be separate from that. So I would still say it's in that cliche, but accurate, 3 to 6 month window of what you need to have set aside.
Definitely. No, that's a great insight overall of, what to have. Because I think that's always just a big question for, clients and business owners of just like, well, what is that balance? And where do we find that balance of, not hoarding cash in the business, but also making sure that we're constantly having that innovation and those kinds of things. But, that kind of balance can just be very difficult to find. Now, you did kind of already touch on this as well slightly of, retirement, once you do have that emergency savings built or, just your cash bucket overall built in your business, what does that start to look like? When do you start having those conversations for, retirement contributions, whether it's creating a solo 401k or even a full 401k plan, or even looking at SEP IRAs, those kinds of things?
It's tough. It depends on what you're doing. We have some clients that operate assisted living facilities. I would say that they didn't have a whole lot in retirement savings. If you looked at it on paper and you didn't count the business, there wasn't much money there. But then one day when those, I don't know how many units there were, let's say 10 units matured and were liquidated, all of a sudden there's $30 million, right?
Yes.
So sometimes your rate of return is higher investing in something that you're an expert in. In their case, they were experts in assisted living. So you could be an expert in collections or expert in, that can go down a whole list of things. And maybe investing in your business is the best rate of return overall. If something happens and the business goes to zero, that's your risk. The stock market is not going to go to zero. Now, if you're buying the index funds, you're not going to go to zero. If it goes to zero, there's a zombie apocalypse and it doesn't even matter anymore. You just need ammunitions and probably hard liquor or something.
Oh my gosh. A safe bunker to hide in.
Right. Well, when the USSR collapsed, that's all that mattered was cigarettes, ammunition, and hard liquor. That was the highest currency at the time. So I don't know if this even matters.
The barter system comes back.
if we get to that point. So again, I will add to this, going back to planning. A lot of times business owners pay themselves to where they don't have to pay into Social Security. That's probably the worst thing that you can do. You should be paying yourself at least $160,000 a year as a business owner to max out Social Security benefit. It makes a huge difference in retirement if you have Social Security or don't have Social Security.
Yes, it does. It's massive.
And then also the same people we're talking to are go, oh, it won't be there. The government, they're very anti-government, and no, it's going to be there. It's not going to collapse. It's 75% of it's funded. So 75% of it's going to be there. 75% is funded by people who are already working. So you got to do your planning to where you're maxing it out. In smaller businesses where you don't have partners, a lot of times they put the spouse as an employee as well and pay them $160,000. So both people get maxed out on Social Security.
Yes.
And then the rest you take as distributions, so that you don't have to pay the employment tax. Right. Definitely. So it's there's all kinds of strategies that should be happening there in a mature business where that is profitable. But what was the question again? I'll make sure I stay on topic this time.
No, it was good. It was really just talking about and through, when and at what point.
For saving for retirement. Yeah. I think
accounts.
as the business matures and you start complaining about your tax bill, that's when you start maxing out 401ks.
There you go.
Because that's $23,500 a year doesn't get taxed. And there's other programs that you could put in place, defined benefit plans, profit sharing plans, and a mature company that can reduce your tax liability substantially. But you got to be profitable first to be at that point. So the goal number one is create a product or a service that solves a problem. Goal number two is then to create recurring revenue over that.
Of course.
And then number three would be, okay, I'm going to start taking care of my future self and saving in these areas. But I'm telling you, most people who are successful in business, maxing out a 401k plan and even maxing out profit sharing may not necessarily hit their lifestyle goals in retirement. So then you have to go focus on the business itself. And then that goes back to business evaluation, exit strategy. Yes. Are we selling it to the employees, right?
Exactly.
Succession planning. No, I don't know of any one company that I've done planning for that had a succession plan in place.
It is, I think, so difficult. It's like, we have families that come in and it's just talking about estate planning. Well, what's going where? And it's such a difficult conversation to think about. And especially for business owners, it becomes so much of who you are.
Yeah.
I feel like it almost can feel like, oh, I'm losing a part of myself if I start saying
no one can do it as well as me.
No, yes. Who's going to do it like I do it? Like I can't give it to someone else.
Which is the whole reason why your business can't scale is because you have that same mentality. But yes.
No, but that's what gets so caught up with people. Is they're like, well, I can't trust someone else to take this over.
I go back to the Kathy family and Chick-fil-A. Do you think that Truett Kathy was like, no one can make this chicken sandwich the way I can make it? No, he created a process.
Yes.
Right. And what people don't realize is Waffle House sold Chick-fil-A sandwiches before there were Chick-fil-A's everywhere. So I did not know that. Yes, so they sold the Chick-fil-A sandwich to Waffle House, and they have a process for making the Chick-fil-A sandwich, right? Then they took it off the menu, and then I think Waffle House may even canceled them. I don't know the difference. I don't know the whole thing behind that, but eventually it became they did the. It's not really it is a franchise, but it's not a franchise at the same time. It's really strange how they do it compared to like McDonald's and all that, But yeah, no, you create a process. I tell you guys all the time, you get the same Chick-fil-A sandwich in Atlanta as you do in Macon, Georgia. So whether someone's working with planning through me, through you, through Shauna, they get the same thing. You know why? Because we have a process, and that process is repeated. It's the same Chick-fil-A sandwich. Hopefully you guys say my pleasure just like I say my pleasure. but it's you have to create process. We in the same way workflows. How do clients call in and talk to different people, but yet still get their withdrawals that they're asking for? It's because there's a workflow, and whether Kyle does it, Tiffany does it, right? It doesn't matter because they just go through the workflow steps.
Definitely. And it's like establishing those processes, because it is something that, like, I think as an entrepreneur, you can get so in like, everything's in my brain. It's all here. But it's like, if you're going to plan for the next generation or a succession plan where you can say, I'm going to step back and enjoy retirement without this stress, then you have to be able to say, okay, I'm going to take this out of my brain and put it down for everyone else to replicate.
Correct.
And, it's creating that process and that structure. And I'm still mind boggled that Chick-fil-A was at Waffle House. I'm just like thinking through processes, but like, wow.
Right.
Anyways.
Long time ago, very long time ago, before you were born, probably.
But either way, I mean, that does just go to show that, like, one, you're to start wherever you start, and it's going to become successful as long as you stay consistent and, disciplined within that, and then figuring out exactly what that process is that has made your business successful. Are you a small business owner? If you're busy running a business, who's making sure your personal finances are on track? Download 5 Reasons Every Small Business Owner Needs a Financial Advisor, a free guide from Wiser Wealth Management. It's your blueprint for helping you keep personal finances secure while growing your business with confidence. Grab your copy at wiserinvestor.com/guides today. All right, let's get back to the episode. So then all the talk with, going through the processes between, just different things of trying to decide, what those processes are for your business. But I think the big, out there idea or really structure that determines those processes is what entity structure you choose. So, who is it, or how did you decide what type of entity for your business, or even who did you bring into that kind of conversation overall?
So the process wouldn't matter how the business structure is, but it's what your end goal is. When I started, I talked to an attorney about which business structure from a legal perspective. It doesn't really matter, LLC, S Corp, or C Corp. It's more of it's a tax person question. Is really should be who be answering that. So I don't want to. We have other podcasts and writings that we've done about the structure difference. That could be all by itself, but basically LLCs are probably the most fluid. You can have money flow in and out very easily. You can have an LLC that is taxed like an S Corp. Meaning that you would take a W-2, but then after that, you don't have to worry about employment tax. And then a C corp is like double taxation because you're going to pay everything at the corporate tax level, profits, and then you're going to pay income tax on your W-2. So you get taxed twice.
Yeah.
But there are benefits of having a C corp. As far as structure, I think most people would be fine with an LLC and then adding the S corp privileges to it once you start having employees. S corps can't have more than 100 shareholders. So if you think you're going to have a lot of partners someday or equity holders, you probably wouldn't want to be an S corp. You have to be more like a C corp or even a partnership like an LLC. Yeah. So there's a lot of nuances, but I think most people start just opening up an LLC makes the most sense. I will say the structure, when you sell a business, most likely they're not buying the company anyway. They're going to buy all the company's assets and goodwill. So from that standpoint, I don't know that it really matters. Succession planning, if you have more than 100 employees and you probably don't want to be an S corp, you probably be a C corp at that point. But for succession planning, and people are going to own equity or member shares, then you'd want to be probably more of an LLC if I had to guess.
Okay. No, that's great feedback there. And I know, of course, bringing in the right other professionals, tax planning, estate planning, all of that into that conversation, but definitely something to talk through and just be mindful of. You
want to get it right the first time. So typically talking to a corporate focused CPA who has done some mergers and acquisitions, and then also an attorney that specializes just in business entities. And those are hard to find. I've worked with so many over the years who the websites say they only do corporate work, and you get there and you're just like, okay, you don't know any more than I do. This is not good.
Yeah.
So we have a few references.
Got to find the good apples.
Yeah, we have a few. If you need references, we have references for both.
No, perfect. Well, then I guess really though the entity structure does really go into tax planning though. Like that's a huge part of your tax planning, which is why you want to have a CPA a part of this conversation. So really when it comes down to strategies for income and expense management, is there anything that you would recommend to, business owners to be taking advantage of on the tax planning front?
It's a combination of both. You have to use your profit and loss statement and your balance sheet, I would say monthly, for business planning. You should make business decisions based on what you see in your P&L. Wiser Wealth Management does not do tax preparation. One, because we wouldn't have a life between February and April. Two, because when we looked at our P&L many years ago, we were like, we have a 3% margin on these things. Like we have to do a ton of tax returns to equal what we get in financial planning and asset management. And so we decided to outsource it. And we do tax planning, which is the important part. A computer can do tax preparation, but tax planning needs to be done by humans. And we are much better at tax planning than we were at tax prep.
Yes.
So that being said, you want to have a P&L, profit and loss statement, that doesn't just say income and expenses. I have seen this so many times. I am not joking. I've seen P&Ls that just say income. And I'm like, you sell 5 different things. How much did you sell of the blue widget? I'm not sure. It's an income. I'm like, well, what if you were making 5 widgets and the red, blue, green, yellow, and purple, you find out that no one was really buying the purple yet. It was really expensive to build. You would probably say, I'm not going to do that anymore.
Yeah.
Right? Because the P&L is the P&L is telling you that. That's why with flat fee planning, it's like, I need flat fee planning to be really successful. Because when I look at my P&L, it's only like, it used to be only 1% of our overall revenue. Well, then now it's like 10% of our revenue. So now I'm like, okay, now it's a legit vertical in the business of flat fee planning versus the traditional model. So you have to make decisions. Also, I can see what profit margins are. So if you do your books correctly, so some people don't want to pay a bookkeeper $750 a month because, oh no, I can just do this myself. But if that bookkeeper could provide you a weekly report saying this is your budget for the quarter, this is where you are actually, this is your profit and loss over the maybe it's a rolling 1 year or whatever it is that you need that to make better decisions.
Yeah.
So then when you understand where things are financial wise, then there's other things that you can add to that. So then you go, okay, we have a profitable company. We have industry standard profit margins. I need some tax relief. That's when you start working in the retirement plans. That's when you might buy a company car for yourself and you depreciate that either all at once, or you can't do it all at once this year. Some of that's been rolled back, but I think this year is like 60%, or it could be 40. I get it confused because time's moving so fast, but there's a large chunk you can write off, and then you write off the rest over a short time period. So there's other things you start working into the business, to start saving on taxes. If you're a manufacturer, there's other deductions that you can take as a business owner. If you're in the real estate, there are certain zones that you could buy commercial property in, or even residential property that you have additional tax benefits. So there's other things that you can add. And your CPA then would be able to tell you these are deductions that you should be looking for, but it all starts with a good P&L and balance sheet. The say balance sheet, because if your company has debt, you want to make sure your debt's not getting excessive.
Definitely. Now, for talking through the CPA, would the moment that you decide you're opening a business, would you just start to say, I'm going to have a CPA from this point moving forward? Or is there a certain point where you would say, hey, I can self-prepare up until it starts getting this complicated, and then I'm going to hire a CPA?
I'm not so worried about preparation. TurboTax is pretty good about that. If you have a little business that you're running and it's arts and crafts, yes, you need to do that by yourself because your margins are zero. If you're trying to create a real business generating, $1 million plus in revenue, then you would go to the CPA first and say, please help me set up a chart of accounts. So when you log into QuickBooks, there's these default categories that you can put your income in and your expenses in, but you are probably not default. No company should ever be default. So that's how they end up with income and expenses. So you need to say, I need help creating a chart of accounts to help me manage my business. And then at that point, if bookkeeping is not your thing, then that's when I would hire a company like Belay. So Belay is they'll do personal assistance, but they also will do bookkeeping, controllers, all the way up to a part-time like CFO. But they'll source it. So you tell them what you're looking for, they find the person. If you don't like the person, they'll get another person. So that company, I think they're based out of North Georgia. It's a great example of finding a bookkeeper quickly, and they'll help you do all that from the beginning. But that's like $750 a month.
Yeah.
And so that seems expensive, but if you can make better decisions because of it, then it's worth it.
Definitely. No, 100%. And I think even like understanding just from the business perspective of this is where our product really is, and this is what we need to be selling, or this is what service we need to be focusing on, versus, this expense and that kind of thing of just churning the wrong thing over and over again. When really, if you just focused on this key area, I feel like that's where a bookkeeper can really come into. It's
kind of like paying off debt. This is not part of the business owner conversation typically, but you think about, we have a young person come in, they've got $80,000 in credit card debt, and they said, but I send $25 extra each card per month. And they've got 10 cards. And you're like, no. Let's focus on getting rid of one card, right? It's the same way with products. Like the old Apple company used to have three things. It had a phone, they had a tablet, and they had a computer, right? Those are three things that you could buy. Now there's like 5 versions of each.
Literally, minimum.
Because they have to keep selling more in order to make the sharavholders happy, and
then keep changing the chargers every three series. Yes,
exactly. I've wanted to. I have to tell a lot of business owners, just like, okay, you want to start in these new verticals, and you have all these great ideas, because many the entrepreneurial seizure, right? Have these great ideas, but let's master one first. Let's master product number one, and then once you've mastered product number one, then go to product number 2. Then go to product number 3, just like paying off debt. Let's get that first card paid off. Let's own it. And then the next card, the next card.
Yes. And it's like, I feel like having those victories is always really like great to keep building upon too.
Yes. Correct.
But then last thing really for tax planning is quarterly tax payments. I feel like these catch, every business owner by surprise. Yep. I don't even know if surprise is the right answer.
Oh no, I'm surprised.
Stress.
I'm stressed and surprised every single year. every single year because we grow at 30% a year. Every year I'm caught off guard. And I haven't learned my lesson yet. So every year I'm going in, and it's funny because you have a client complaining about a $5,000. They owe $5,000 this year. Oh my gosh, this is crazy. And I'm sitting there going, I would love to owe $5,000.
Yes.
No. I could buy a house. This is ridiculous. Yes. So this is where it goes back to your P&L and owning your P&L and then forecasting. And what's that saying about the shoemaker's kids have no shoes or something like, you know what I'm talking about? The old saying.
Like they're like all worn out because you don't take care of your own, but you take care of everyone else's.
Unfortunately, that's me some years because I know I'm growing, but I'm so busy helping other people, I forget to help myself. But the point is you have your P&L, you're forecasting what your sales look like. And then when you're sitting down with the tax planner or the CPA, you kind of know what's happening. The most important thing I think is if you pay in 110% of what you paid in the year before, meaning you're on track to pay 10% more in tax, you'll avoid all the penalties for underpayment.
Yeah.
You just got to get yourself to the 110. That's the minimum number. And then the next year, to do it accurately, you probably want to, every 3 months, you would say, okay, this is my profit now. What's that trajectory? And then you pay it in. Some people are much more disciplined, and we have many business owner clients that say, I take 30% of all my revenue and I put it in this account, and that's for my tax bill. And sometimes they're still caught off guard because 30%, if they're not paying in either any other way, then what happens is that they're in the 37% tax bracket plus state tax, so they end up being short. But they're better off by having some reserve set aside. Donald Miller talks about this too, where he has a cash bucket strategy so 15% for him goes into the profit account. You don't ever touch that. And then he puts, I think it was 25% goes to tax. You don't touch that. And then the rest goes to operating. So every time a dollar comes in, it always goes in those categories. And if he's having to dip into his profit account, then something's wrong.
Yeah.
And so I have a hard time doing that. I set it up one time. It's like, this is what we're going to do. And it's really hard to revert back to something. But if you can start off that way, that's a good strategy.
No, definitely. Well, that's great feedback on this. I feel like that's definitely something that everyone just gets caught up on, and they can taxes just in general, I think, stress everyone out.
Yeah.
Especially if it's not something you're well versed in, it can just feel very daunting.
If you're a business owner, you cannot do your tax planning at the same time you're filing your tax return. It is too late. All your tax planning really should be done 4 times a year.
Yeah.
So you should be going in every single quarter for a tax meeting as a business owner, especially I'd say a successful business owner. When you're just starting out, you don't need that. You need maybe one time a year, have an idea, maybe a check-in in September, like most people would do.
Yeah.
But as a business owner, you need to be on top of that every single quarter.
Yeah, 100%. Now, going back a little bit to succession planning. So we've already touched on this quite a bit, and we've talked about the importance of that. But I mean, kind of just talking through, like, if I were a business owner and I were to say, what if I want to sell my business eventually? How do I plan for that financially?
Well, first of all, you're ahead of most people because most people haven't thought about selling their business. So there's a couple of things. One, your business is probably your biggest asset. And if you get hit by the train or whatever, what happens to your business? Like, who's going to take over? Is your spouse going to take over? Most likely they're not engaged at all in that business. Do you have employees that can take over? A lot of people go, oh, I don't know. I don't think so. But you might actually have it. They may not do it exactly like you, but the business could be okay. Do you have children that could step in and have the wherewithal to take over? Or is there a partner or a frenemy in your industry, right? That you would say, okay, we share ideas and stuff. And it might be a good idea to have like a buy agreement with them. So you have to have a succession plan. That's where you need to start. If something happens to the business or if something happens to you, how does the business move forward? It could be immediate liquidation and it goes to X person, and that's fine. You might have to buy life insurance. It could be a long-term term insurance or universal life policy, something that would allow that person to buy it.
Yeah.
And So that's step number one. So a business is worth more if there is a succession plan by default. Could be selling it to all the employees. There's so many ways you can do it. And there's no one right or wrong way. It's what all the parties agreed to in the end. So once you understand that, then that's going to send you down a different journey, and that's business evaluation. So then you have to find someone. It could be someone within the industry. It could be industry organization, somebody that has a standard of, this is what the profit margin is. This is typically how your business gets sold. So I know how financial advisory firms get sold. I understand that. If you had a sign making company, I don't know. I'd probably need to go to a broker and say, hey, is it 5x EBITDA? Is it 3x EBITDA? Is it 10x gross revenue? I mean, how do we look at this? Do you have equipment that's worth something? If you have a trucking company, those trucks are worth something. So that's on the balance sheet. So once you understand the valuation, then you can go back to your succession plan and you can put a discount on that, because if you're dead, it's probably going to be worth less unless your business is running without you. And that's the case, then it's worth a lot more. So that's another part too. You'll realize as you go through this journey is that you need your business to run when you're not there. And then your business is worth more.
Yes.
And then, so once you've determined all that, then it goes back to that P&L, and you're trying to figure out each year, okay, how do I make this business look more attractable to a potential buyer? And some people try to cheat a little bit, and they do things like, well, if I didn't have all my personal expenses in here, then it's worth X. And you're still not getting the best valuation. You have to separate you from your business.
Yeah.
You're going to have to pay more tax. The more tax you pay, the more profitable, more money you're going to get for that business, and you're going to get a higher margin for that business than the tax you had to pay. So it's better to just pay as much. You want to pay as much tax as possible.
Yes.
Those last 3 to 5 years, if you have that opportunity.
Yeah.
Some people don't. I actually consulted a long time ago with the lady. Her husband passed away. He had a vet business, and he got cancer, and he shut his practice down.
Oh my goodness.
He said, well, I have cancer. I can't work anymore. So he sent a letter to all the people who brought Fluffy and to the vet and said, you have to find a different vet. And he'd already passed away by the time she came in for help. But I was like, oh my gosh, why would he do that?
Yeah.
Like, he owned his own property. He owned the vet building itself.
Oh my goodness.
Why wouldn't you have sold it to somebody coming out of medical practice or merged it with another practice? You have people who are regularly coming to your vet.
Yeah.
He valued his business at $0 and he just walked away. I'm not saying he walked away from millions of dollars, but even if it was $200,000, right? He could have introduced a new vet.
Yes.
But I'm guessing what I think happened there is, like, no one can do it like me, or he just had no vision of how you would do that. If anything, they buy the building. Now you have an empty vet building, and how do you sell that? Because those are built very differently.
Yes, they are. Oh my goodness, that's heartbreaking.
I know. So you don't want something like that to happen to your family. So you have to be thinking ahead as a business owner. That's why you've got to get out of your business, go away somewhere, think about this stuff. Don't do it at the business.
Yeah. Well, I also think it's important to understand your value too. I think you have where you're like the guy with the vet, where you're like, my business isn't worth anything. I just come here every day and I pay all these people, these techs, and it's not worth anything. Like, it's just my passion.
Right.
But then you have other people that I think fall on the other side of the spectrum, where they're like, my business is worth $10 million. And you're like,
and they have like $500,000 in revenue.
Yeah, exactly. And you're like, okay, maybe in the future, great to have goals. But I think it's like having that real conversation about valuing your business is huge, and understanding what that value is.
And you can get basic business valuations done for like $10,000, but the problem with a lot of that is, even people who evaluate businesses don't know how to evaluate businesses. So you see that in our divorce cases. People get divorced, and we had a case where orthodontists was getting divorced, and they valued the business at like some stupid low number. I'm like, what? There's no way. Yeah. Like, he's making $1 million a year, and he's worth $500,000. Like, this doesn't make any sense.
Yeah.
So there's situations like that that can make you go, huh? That's why you need to find you need to be a part of like an industry organization that can help you in your industry make those decisions.
Definitely. Now, last question here, and I think we're trying to make this a new segment on the podcast, is what I've been told, is like a case study question. So this is essentially a question that we just get asked quite a bit, is how much can I contribute to a solo 401k if I pay myself $60,000 in freelance income?
Interesting.
Yeah.
Well, you can put in $23,500 a year if you're making 60 grand and you're under the age of 50. And then above that, it would be basically 25% of the company's profits.
Yeah.
So if you kind of a trick question, I guess, but if you paid yourself 60 and that's all you made was 60, then 23,500. But if you paid yourself 60, and you made a company overall made like $250,000, then you could put in 25% of the $250,000. Ideally, you'd be more profitable, and you could be putting away about $70,000 a year into a solo 401k. Of course, the trick on the solo 401k is you got to be solo.
Yes.
So no employees.
Yes.
You can have husband and wife.
Yeah.
So if you're working together, maybe husband and wife as a consulting or company or something like that. You can both have solo 401ks. You could put away $140,000 a year pre-tax.
Yeah.
Which is crazy.
That's
we
awesome.
don't see that very often,
No.
but it is possible.
No, 100%. Well, I mean, honestly, that was my last big question of today, just to pick your brain and see what your thoughts are for entrepreneurs. But is there anything we haven't touched on today that you would love for entrepreneurs to know?
Well, you always want to make sure you answer the question that the podcast is titled. So, we talked about fluctuating income. So let's just go back to, you have to maintain your P&L in the business. You need to have business meetings with yourself at least every quarter to understand the pulse of the business financially. And then from there, you can make better decisions, which allow you to budget your cash flow better. What I tell most entrepreneurs is you need to create a steady stream of income that comes to you. And that's the bare bones minimum that you need to live on. And then above that, you can take draws, like in an S Corp scenario. You would take draws on top of that, but those draws might fluctuate based on how profitable the business is. And then we didn't really touch on this. If you take on partners, you need to make sure that you have a good legal structure. So many times we've seen partners with no agreements, and that's where bad things happen when there's disagreements. Dave Ramsey even goes as far as saying partnerships are the only ships that don't float. He doesn't like partnerships, but there's many partnerships. Most law firms are partnerships. So you just want to make sure that you always have good, solid business agreements in place, and there's an exit strategy if something happens.
No, because I think that good faith can always come into it's kind of like your whole, you're even talking through just families in general. They're like, oh, the kids won't fight. And it's like, oh no, they'll fight, and so you just you have to plan for the worst case scenario.
Put the guardrails out.
Yeah.
I kind of look at it as like, it's much like dating and marriage. You meet a dreamy guy or a dreamy girl and everything's going to be great. Everything's going to be great.
Glasses.
And then, there's no prenup and then it goes really bad. Then you're like, oh my gosh, this is horrible. So you got to have an extra case in point. I bought this firm in 2007 and I had to use my exit strategy or use my termination clause with the person I bought it from after the first year. Inside the first year, he went kind of nuts, and so that I didn't have it in there. I had a good attorney who said, "Casey, you need to put this clause in there if he'll agree to it." We added it, and he was like, "Oh yeah, that," because he had dreamy eyes too, so he was like, "Oh yeah, that's not a problem."
Yeah.
And then less than a year later, we weren't making good decisions. And so I was like, okay, your retirement starts today.
Yeah.
It was only a year early. It's not like he didn't own any more equity in the company. I bought the company. It was more like an employment agreement.
Yeah.
But you got to think about those things.
No, definitely. The attorney was like, case in point.
Yeah, exactly.
Well, thank you, Casey, for all of your advice today. And to our listeners, thank you for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. or you can click the link in the episode notes. We'll see you next week. But before that, just be sure to look at our related podcast episodes. So episode 218 is about budgeting tips for pilots with variable income. Episode 283 is for how to manage a sudden money windfall. That's with IPOs, business sales, or even inheritance. And then episode 247 for why it's crucial to separate your business and personal assets. Then we also have some financial education videos out there as well for why business owners need an exit strategy, as well as asset protection strategies for business owners. So with all that being said, now we'll see you next week.
See you guys.